So, welcome, Adam, joining me for a little investment commentary. Something we don't frequently do in this kind of setting, but here was the idea. We are essentially at the end of September. We've gone through what we would deem to be a more than normal volatile month, although within the context of 2020, this like, hey, whatever.
Yeah.
But I think it's really an okay idea to kind of share our perspective on what has actually been going on, maybe the reasons for it, but more importantly, focus on where we feel like we are in our investment process for our clients, and making sure that we kind of hit on our philosophies through that process. So sharing the context, the S&P 500 went through a 10% correction in the month of September, which is, looking at a very good August in most of the broad markets led to an all-time high, which again sounds crazy to say in the year 2020, but an all-time high on September 2nd. And by September 21st, and then again on September 23rd, it had been down from that high down to 10%. So I guess my first thought was to talk about maybe some of the plausible reasons for that pullback, because we know it's never one thing.
Right. Yeah. So
do you have something you want to share?
Yeah. So just real quick, in just looking at where we've gone this year as a whole, had we started in January and told clients that, the stock market would essentially be flat at the end of September, we would have been disappointed. And now knowing what we know in hindsight, it's miraculous that the market is flat at the end of September, considering all the stimulus or the stimuli, all the things that have happened between now and then. So to answer your question oh no, go ahead.
Well, I think that was a good context to start with. And then, to say that we were 10% higher from where we are today, a couple of weeks ago, probably means that things got a little overbought. Maybe there was a little bit too much euphoria for where we really are coming out of a recession.
Yeah, we often like to talk about the stock market more so than the bond market, that typically that pendulum swings a little too far in either direction, both to the upside and to the downside. So we certainly felt that way back in March when things just seemed to continually get worse. And at some point, that had to stop. The market's not going to go to zero. But at some point here, the last few weeks of August, it just seemed like no matter what the news was, the market was heading higher and significantly. So to build on what you said, the market feeling overbought, everything was I shouldn't say everything. There were certainly sectors of the market that are not doing as well as others, but on the whole, it just felt like it's time for a breather. That's a very natural thing in the stock market, right? At some point, things have to recalibrate, have to reset before we can now start that next move, whichever direction that is.
Yeah, I like that point. Just quick napkin math. Since April 1st, right? So the bottom of most of these markets was the end of March. You said it well, based on not only Fed, bringing liquidity back into the markets, but government stimulus. We've gone through 7 5% corrections, right? Which just means as much as things have gone up, we have had these breathers, right? This one being a little bit more than the 5%, but again, it's very healthy. But let's talk about the fact that we often talk in terms, you said it, the market. The market can mean many different things. If we are digesting things and going a little bit deeper into details, this drawdown in September was really led by tech, correct?
Yeah. So kind of when we talk about the market, we typically talk about the S&P 500, being that it's 500 stocks as opposed to the Dow being only 30 stocks. Yeah. The makeup of the S&P 500 is a little more broad when it comes to companies and sectors.
Yep.
And then you have the NASDAQ, which is very much technology driven. And they've all reacted differently, certainly this year. So to your point, tech has really brought us down here as of late. But up until this point, tech has really kind of drug everything else along
Yeah.
by being one of the sole areas that is performing well for the year.
Yeah. So to see that being sold maybe isn't giving as much pause, but then, other plausible reasons for 10% correction in 1 month, we're going to get the question. We've already had the question, is some of this just election uncertainty? I mean, what are your thoughts?
I think so. We talk about, the market, and it's that uncertainty that really drives volatility. When there doesn't seem to be a clear direction or clear information, it really, you're having that tug of war between the buyers and the sellers. And at some point, you get enough people leaning one direction and it is a momentum shift can occur. So I think right now we're seeing that, just that uncertainty in the election is a huge part of that. Trump came out, whatever it was, a few days ago and said, to the question of, is there going to be a peaceful passing of the torch should he not be elected? And I think he's been consistent with his answer, which didn't really give any certainty, because his answer was, well, we'll see what happens. So the market as a whole doesn't like that as the response. They would like to kind of know what the rules are or what to expect moving forward, so that you have an idea of where to place your bets, essentially.
Yeah, and I think, if I were to respond to that, within the context of what happened in September, I think the uncertainty around more government stimulus is probably driving things more than what could be election results in November, or if that gets drug out into, later in the year, if there's some sort of contested election. But the reality is, economically, things have been getting much better, right? Unemployment has been getting better. We are trying to get this economy back to quote unquote normal. But there are still a lot of people hurting, a lot of industries hurting. And the fact that, both sides of the aisle have not been able to come together around the stimulus, the market is now seeing, wait, there's not going to be more coming anytime soon. That hasn't been a positive reaction, and at this point, we're almost in the 11th hour. If they don't get something done by next Wednesday when Congress goes to recess, then it's just probably going to wait. Could that bring more volatility? Sure.
Yep, absolutely. Yeah, and I think it was earlier this week. Steve Mnuchin was in front of Congress, and Jerome Powell, the Fed chair, they both basically said a similar statement of, more aid and more stimulus is going to be needed to kind of see us through this. We're certainly not out of the woods yet. And the fact that we haven't seen that, or at least it seems like the sides are so far apart at this point.
Yeah.
That's certainly being factored into the volatility in the stock market.
Yeah. So then let's flip the conversation a little bit. How do we think and feel about all this for our clients, right? We kind of hinted on these corrections are pretty normal, right? Uncertainty is always going to be in the market. But let's focus back on what to you and I, let's share the private conversations we have. What are we thinking about? Where are we in a rebalance process, or where are we with our allocations? What are the takeaways here for our listeners?
Yeah, so I think clearly one of our philosophies is long-term views of stock and bond markets. So our job is to help filter out a lot of this short-term noise. That doesn't necessarily mean that everything that's occurring right now is noise. But for right now, it's we take that longer-term approach. We've certainly had a lot of conversations recently about rebalancing our portfolios, depending on how severe this little correction gets. If it does go further, then it may make sense to kind of recalibrate, reset, go back to our original, intended targets. It's a prudent thing to do.
Yeah, and I think to even get a little more granular, and of course we're not speaking to any one individual at this point, but when we say target allocations, depending on anyone's individual plan, like we have a set, here's how much risk we're willing to take, right? Risk thinking more about equity versus bond. And there's always that ratio. And sometimes we use that jargon. It's a 60-40 portfolio, or it's a, you know, 35-65, we're talking equity to bond. Most people at this point are pretty close to those targets, not far off. So again, we'd have to see more of a 10%, more than a 10% correction to feel like now we're kind of forced into action for the good of the portfolio. So
yeah, and even
go ahead.
I was going to say, even to that point, the broad allocation of stocks to bonds within that, it can get really granular on the growth side or the tech side versus the value, which is your utilities and financials. Just the disparity year to date of individual sectors. So even though our overall stock to bond may be accurate, within our stock allocation, we may be overweight now to tech because that has done so well. So even just recalibrating that may not change your overall stock to bond ratio, but it does, again, it may change the details underneath the surface that I think do matter over time.
Yeah, and I guess that's the point I wanted to make with you and for the listeners, right? That's the stuff that we need to pay attention to. Mm-hmm. Just because we go through these hiccups doesn't mean we have to do something, right? We're always going to go back and look at things very fundamentally on how we have things allocated. So, as far as actionable steps, it's not to panic anyone. We don't need to panic. Right. To your point, we're going to stay diversified. We're going to follow the fundamentals. We're not going to try to time the markets. But I guess the other thing, what is actionable or what do we want to share? We don't anticipate that volatility is just going to go away. I don't think it'll just go away on the other end of an election either. So It is preparing ourselves, not to think like March 2020 is going to happen again, but to again look at this stuff as kind of normal. Headlines are headlines. We'll do our best to navigate it, but we're always going to come back to that target allocation.
Yep.
I guess the only other thing that I would kind of want to note, in looking at kind of what has happened here in September, it does go back to the election. I think we're going to hear a lot more commentary on the what ifs, and I think that's going to get people charged up. If I could throw out not a prediction on who's going to win or what the makeup's going to be, but we need to keep the big picture that whatever happens in November, the president, whether it's the current one or a new one, and whatever new makeup of Congress, they're still inheriting, right, an economy that needs to recover coming out of a recession. And they're still inheriting a lot of debt, which is going to make spending a lot of money, regardless of what their platform is, pretty difficult. So I think we all, once again, just need to kind of put our personal values, personal political beliefs kind of on one side of the table and recognize that the investments really need to stay separate. Because at this point, I don't know that there should be any major long-term market implications to what happens in November.
Right. I agree.
All right. Well, hopefully that was helpful, under that context of what's happened in September. And I guess we should give the disclaimer at the end. All of this could be irrelevant tomorrow, right? Things are happening quickly. They always do. And this shouldn't replace any individual conversations that anybody wants to have with us. So
yes.
Thanks for the feedback, Adam.
All right.
Onward and upward. We hope.
You.
See ya.